Welcome to my solo 401k financials podcast. We're very excited to have as our guest and as our topic today, unrelated business income tax and unrelated debt-financed income tax. It's a hot topic for our clients and our followers of our website and social channels. We have a real expert in this area, Stephen Hamilton. So welcome, Stephen.
Thank you for having me. I'm always excited to talk about tax and especially the strategies that we have with retirement accounts.
Excellent. Yeah, well, we appreciate your time. I know it's probably been a hectic and busy time. How has life been in this brave new world that we're in?
Well, it's been a definite line in the sand between the procrastinators. We've had people coming out of the woodwork who haven't filed tax returns in 5 years. We have individuals who are looking to plan early withdrawals, et cetera, taking advantage of some of the CARES Act. So it's been a little exciting on top of, the usual people who like to kind of slack and provide stuff at the last minute. But it's been a fairly nice balance overall. I can't complain.
Well, that's great. Yeah. Yeah, it's been, I know the IRS has been in with the laws and the IRS guidance coming out. There's been plenty of topics to digest. And
yeah, they only dropped an 880-page law in the middle of tax season. No big deal. Retroactive.
Retroactive, yeah. Perfect. So now tell us, where are you at geographically, Stephen?
Oh, that's actually a great question. My wife's also an enrolled agent. So what happens is we actually bounce back and forth between Illinois and Florida. So we have a nice presence down in Florida, and I spend a lot of time up in Chicago. We kind of have the best of both worlds going on at the moment.
Okay, so if you are coming from Chicago, you must be on the Gulf side then, I'm guessing. Is that right?
When we're down there, yes, we're on the Gulf side.
Yeah, it seems like the folks from the Midwest go to the Gulf side, and the East Coast, it goes to the Atlantic.
Yeah, I think you're right on that one. I never noticed that, but yeah, that sounds about right.
Yeah, my grandma was my grandparents were down on the Sarasota when they were alive. So beautiful beaches. They got those wonderful white sandy beaches.
Well.
What's that?
I know that IRS office well.
Okay. All right. Yeah. Luckily, when I'm down there, it's just for vacation. So I'll try not to think about the IRS.
I have about 10 cases with that office right now.
Okay. Well, why don't we get started? We've got some slides to flip through, and you can just guide us through these slides maybe, and I'll hit the switch, and I'll maybe chime in with some dumb questions. So
that's perfect. Okay.
All right. Thanks, Stephen.
Do you want me to start with kind of a quick intro here of what UBIT is and what UDFI is?
Exactly. Yeah. We've got the roadmap here. What is it? What are these topics? How much is it? Examples. And then, of course, people want to stay around till the end so they can get more info about how to contact you, how to contact us about their situation. So before we get started, though, I should give a disclosure. This presentation is being provided for educational purposes, should not be construed as tax, legal, or investment advice. When making an investment decision, please consult with your tax attorney and financial professional. So what is it? What is UBIT?
That's a great question. So UBIT, and you'll often see it listed two ways, either UBTI or UBIT. So UBIT, Unrelated Business Income Tax, is the physical actual tax that you pay, where UBTI, also referred to as UBIT, is the actual taxable income that is generated from certain entities.
I see.
So the short version, when we have a nonprofit or a retirement account or an entity that normally does not have a tax liability, when they have certain types of income that are not deemed regular investment income, they are subjected to an income tax. The goal is to kind of level the playing field. Otherwise, you would have people who own entire large corporations all through their retirement account, and their goal is to never pay a single dime in income tax ever again. We want to try to avoid that a little bit. So UBIT completely levels that playing field. So we're going to see an IRA, a solo 401k. This will also apply to most nonprofits. That's kind of the short version in there. The goal is to avoid a trade or business. So the general purpose of a retirement account is to grow funds for future retirement and to be passive about it. I shouldn't be actively day trading in my retirement account. That's the kind of the general thought. I shouldn't own a McDonald's in my retirement account. That's the
Right.
conventional thinking and the reason behind this tax. Are there ways around that? Yes, they cause a lot of hoops to have to jump through, but it's usually not worth it for a reason. So investment income, the items that are typically excluded from being considered taxable income, that would be interest on loans. So let's say, George, you're going to flip a house and you're looking for a hard money loan. And I decide, my retirement account's going to loan that to you. That interest income that's paid back to my retirement account, that's not going to be taxable. My interest on a bank account, savings account, money market, those are not going to be subject to UBIT. The average rental property is not going to be subject to additional tax, as well as gains and losses from the sale of real estate. Again, typically not subject to tax. There's some big exceptions to those if we use debt financing, and I'll get to that in just a quick minute as we explain UDFI. Annuities and royalties, again, unless you hit any kind of specific debt financed realm, you're really going to have active income from there. On the royalty mark, what's very common is for someone to purchase mineral rights to a property inside of the retirement account.
Sure, we've seen that. Yep.
Perfect.
Yeah.
And you might also have oil royalties as well. Also lease payment.
Yep.
Those would typically also be exempt from UBIT itself. So that's usually a pretty good day. Dividends from stock in a C corporation. So for example, you buy 100 shares of Microsoft, and I'm probably going to use that example a couple of times in here. Those dividends are not going to be taxed to your retirement account. They're considered passive and they're excluded from UBIT. Because
Microsoft's a C corporation, right?
That's correct. That is correct. In general, one of the specific realms it specifies dividends themselves. So that would also apply to mutual funds, etc. So let's talk a little bit further about business income that is generally included in UBIT. That's going to be equity investment in a pass-through entity, your partnership or S-Corp. However, I'm going to warn you on the S-Corp side, you really, really shouldn't have your retirement account own any shares in an S-Corp, because that can actually terminate that S-Corp election.
Yep, absolutely.
So we try to avoid that wherever possible, barring any kind of specific private letter ruling or tax court determination. I don't anticipate that to change anytime soon. So your retirement account should not own an S-Corp. In fact,
you're right.
Ironically enough, you mentioned Sarasota when we were chatting a moment ago. I just got a call from another accountant down there who, client of theirs, took on a partner in their S-Corp, or shareholder in their S-Corp, and inadvertently terminated an S election.
Yeah, great.
So it does happen. It definitely does happen. Rental income from personal.
Misery loves company. Misery loves company.
Amen. Rental income from personal property. So if we are, I'm going to use the example of an equipment rental. That would be something that would end up included in UBIT and subject to tax. And those tax rates can be pretty darn hefty.
Yeah, I think we're going to talk about the tax rates in a second, but just to get the concept down, and you're exactly right. I mean, this UBIT doesn't, obviously you're the expert. What I always understand about it though is that it's not just a tax that applies to retirement accounts. Think about it. It could apply to a church, could apply to maybe a school or some other, where let's,
an example, college, university.
There you go. Exactly. So these entities that have special tax treatment under the law, and then all of a sudden they get astray from really the reason that they got special tax treatment. Like in the case of retirement accounts, saving for retirement, all of a sudden, or I think of a church, they're selling donuts on the weekends, and all of a sudden they're making good money selling those donuts. They decide they want to sell donuts every single day of the week, and they put out the local donut shop because, the local donut shop has to pay taxes, and in the absence of this tax, the church wouldn't.
That's exactly the point there. That's exactly why they designed this. You hit a great one on the church, and I'm going to use that example really quick. A common way that this ends up applying is, let's say, I don't have any heirs, and I decide that I'm going to leave all of my assets to the local church. Well, if I own a small business, that church could end up owning those shares or own shares in a publicly traded partnership. And next thing you know, they have a UBIT liability.
Right. Yep. So, that's probably something they weren't expecting on, get that, you're getting a gift and it's actually more of a pain,
That's correct. That's correct.
But, okay, well, should we talk about debt-financed income tax now?
Yeah, let's definitely jump over there. All right, so UDFI, Unrelated Debt-Financed Income Tax. Yes, the F is before, and there's no T in there. I get it. But UDFI, it never seems like it's in order, and there's no T in UDFIT, so ironically.
Yeah.
The income that would otherwise be excluded from unrelated business taxable income. Oh, this is fun. So I'm going to use that example of a rental property, $100,000 rental property, and it's left to the church, and there's an $80,000 loan on it. Well, 80% of that $100,000 property is going to be subject to tax. And the reason that they do this is to prevent that entity from getting a leg up. So we're avoiding income tax by it being a nonprofit or a deferred tax situation, or in the case of a Roth, we front loaded the tax. We're going to end up in a situation where that debt-financed income, whether it's in a partnership, whether it's stock margin, whether it's that rental property, the goal is for it to have just instead been an investment account. So it's kind of punitive in a way, but they're trying to, again, level that playing field. If I have, a cash-free account, well, why don't I leverage, the $500,000 that's sitting in my retirement account? Why don't I go out there and put 20 grand down on, a whole bunch of $100,000 properties over and over and over again? Well, then it's going to be in a situation where that retirement account actually has a leg up on the other individuals because it doesn't have a tax liability.
I see. So it's still to level the playing field. That's kind of the public policy objective underlying it. Okay.
Both of them. Yep.
Let's unpack it a little bit, because it says income that would otherwise be excluded. So let's say that let's turn that around. So let's say income that would be included. So let's say that because let's say it's an Airbnb where you have short-term vacation rentals.
Yeah.
If it's very short-term, average, let's say, I think it's less than 7 days, then
7 nights.
Then that income is considered business income. So if it's inside of your 401k, potentially business income, right? So that could be subject to the unrelated business income tax. And even though you financed it, 100% of the income is included.
In that case, yes.
So you don't get to because with the UDFI, it's based on the ratio, right? It's based on the percentage that's financed, which is obviously a moving number, because presumably you're paying that debt down. Yep. But so you only pay only a portion of the income is subject to the tax. But if it's a business income, the fact that that business might have leverage doesn't get you to reduce the part that's taxed.
Correct. That is correct.
But you also don't have to pay a double tax, right? You don't have to pay unrelated business income and then pay UDFI on top of that.
And actually, that's a great item right there. So UDFI, Unrelated Debt-Financed Income, is subject to UBIT. That's the easiest way that I can explain it. So it's not an extra tax. It just means that that debt-financed portion is then subject to income tax. Mm-hmm. So if you can back up a slide for me real quick, we talked about some incomes that are excluded. Okay. So investment income is generally excluded. Interest from loans. But if I'm leveraging and I borrow $20,000 from Sally and I loan you $40,000 in total, 20 from Sally, 20 from me, I'm paying Sally 2% and you're paying me 10%. Well, I then have debt-financed income. So that interest would normally be excluded, but now 50% of it is subject to tax because I borrowed it.
Got it. Or if it's like maybe stock on margin.
Same thing, same exemption.
Microsoft, the same Microsoft stock, all of a sudden now some of that income is going to be subject to, if some of that income is considered unrelated debt-financed income, and therefore that part is subject to UBIT.
Correct. Now, typically, if you're trading on the underlying stock, it's not an issue. So think covered calls. Those are usually going to be just fine. It's just an agreement to sell it at that point. Now, gains and losses from the sale of real estate. I'm going to jump on that one real quick.
Okay.
So if we sell a property that's debt financed, a percentage of that sale price is going to be subject to UBIT. And that's another concern that we have.
Got it. Okay, but let's talk about isn't there the exception for qualified plans, real estate that was acquired by a qualified plan?
Yes. Now, the exception to that, yes, will apply to qualified plans. Your 401k is going to be the simple version to explain that. That's why I will always pick a solo 401k over an IRA whenever possible. I don't care if somebody is driving for Uber a couple times a year as some self-employment. You know, just something that they do on an ongoing basis that can, as self-employment, that can sponsor that retirement account. I will push for all day long. Ideally, it's going to fit great for your realtor, your self-employed salesman, etc. But yeah, your solo 401k is going to be the hands down ace in the hole if you're debt financing real estate.
Huge advantage. Okay.
Big advantage.
Mega advantage. Okay, so let's go through some examples. Or no, first let's talk about the tax, actually paying the tax, and then we'll talk about some examples.
Okay.
So can you walk us through this slide, Stephen?
Sure. So your first $1,000 is not subject to UBIT. So if I have $1,000 of net profit, that's going to be exempt, you know, if it's debt financed. Then from there, I'm going to, and that's after I've deducted all my expenses, depreciation, losses. So the average rental property that might show a small tax loss is probably not going to pay anything in UBIT if you're going to be holding it for a while. That said, your UDFI is based on the average debt ratio. And if you have a year that's really good, rent continues to skyrocket, and now you are showing a net profit. Well, if you're showing a $5,000 net profit and you have let's say an interest-only non-recourse loan that covers 50% of it, at that point, you're going to be looking at 50% of that $5,000 net profit being taxable. But then we have our $1,000 reduction in there. So you'd have tax on $1,500. The tax rates, though. So if our taxable income itself is not over $2,600, then we pay 10% on it, which 10%, that's not a big deal. That's fine. But then we start to look at if we go up a bracket between 26 and under 9,400. Well, now we're looking at 24%.
Mm-hmm.
I might as well be holding it outside the retirement account there, is what the average person is going to think. Then
Right.
Over 94, but under 13. And keep in mind, we're talking about a $3,500 span in there, and you're going to pay 35% on that. It skyrockets very quickly. But over that 12.9, 37%. We've already hit our top tax bracket. So we have to really plan and really have a great return on investment. The alternative I can say is if it's in a nice Roth account. That's where this type of investment that we know we're going to be paying tax on is probably going to be better off. Yes, I'm going to have some small tax on it, but I might be looking to kind of leverage a little bit more knowing I'm not going to be subject to tax when I pull it out later. Because if I have to pay tax on the growth and then I have to pay tax when I withdraw it, your traditional account starts to look really bad for UBIT.
Got it. Okay, that's some good feedback. Now, let me ask some questions. Do I get to reduce my finance? Let's say it's UDFI. Do I reduce the income by my loan payments?
By the interest portion, so not the whole loan payment.
The interest portion. Got it.
So it would be just like any other rental outside of the retirement account.
Got it. And do I pay it, or does my retirement account pay it?
Your retirement account's going to be cutting that check, so you better have the funds in there to pay it.
Got it. And then, and it looks like I'm going to have to pay estimated tax every quarter, I guess, right?
If you expect the tax will be $500 or more, that is the case. Now, in that type of situation where I mentioned with the rental property, it's a great opportunity for me to look at maybe utilizing a cost segregation or some other strategy where I can offset some of that tax and carry over some losses for a few years to help offset some of that income. So there are some strategies we can use.
So let me ask you a question, Stephen. Where do you like to get involved? It sounds like before the person buys the property?
Every step of the way. Every step of the way. So I don't actually set up the retirement account itself. I forward people to you guys.
We do that. But as far as, like, let's say we got a customer, should they come to you with their proposed numbers and you can help them figure out what the tax is going to be?
That's exactly it. So I want to talk with you before you open up the account to make sure that we're opening up the right account for you. Because we want to make sure that, hey, somebody might be thinking about an IRA and I can push them towards a 401k just based on the fact of that UDFI not being applicable on a rental. I can't tell you how many people I've saved from that problem. But I want to talk about what that deal is. What are they going to be investing in? What's their strategy going to be? So that way we can make sure that they are doing the right things and that they're not going to be subject to a ton of tax. They might be better off with some of it in a traditional or some of it in a Roth and figuring out every situation in between.
Right. So it's not always a one-size-fits-all solution.
Nothing in taxes.
Yeah.
My favorite two words are "it depends."
Yep. As an attorney, I can relate. So. Great. That's great information. So let's go through some examples.
Yep.
So we've got some common examples listed here. Maybe we can pull out some of these and talk about how it might work.
Okay. So we talked a little bit about buying rental real estate with a non-recourse loan. So we already kind of talked a bit about that. If you want to talk about it a little bit later, we can jump back in there. This is one of my favorites, a high volume of fix and flips. Hey, George, do you have a definition of high volume?
I mean, it seems like the scuttlebutt has always been more than two.
I would kind of agree with that. If it's kind of a casual situation, you are probably fine. I've heard of a case, but I haven't been able to track it down, where somebody supposedly got away with 3 flips inside of their retirement account. But I also know that they had a ton of other activity. So they weren't just flipping in that account. And I think they found that that was part of the decision in determining if it was an active business. So we look at the combination of everything that's going on. You might flip 2-3 houses, but if you have 90% of your portfolio that's sitting in the stock market, I might not be as concerned and it might not reach the level of being a trade or business. If you're the person that just wrote the check and you got a check back, well, then you probably weren't very active in it.
So the rich get richer.
I'm not arguing there. So that really is going to be kind of it depends on the exact facts and circumstances of the situation.
Yeah. Ooh, second favorite phrase, facts and circumstances.
It does. And oftentimes when we're talking about a high volume of flips, it might be a good opportunity for what's called a PLR, a private letter ruling. And if we're thinking about doing a whole bunch of flips in there or a high percentage of volume or a certain structure of situation, in terms of primarily not being a lender, but being an equity partner, et cetera, I'm probably going to want to say we might want to dot our I's, cross our T's, just to rely on some specific evidence. There's case law in a lot of these, but there's not as much case law as any accountant or attorney would like to see.
Do they have, let me ask you a question. Do you have clients that want to go that far very often to the PLR stage?
Not very often. Usually once I mention the cost of the PLR, they kind of get a knot in their throat because it's I might make, 5-10 grand on a flip and I want to do 5 or 6 of them. That's not going to be the real big case for it. We're talking the person who's going to be doing 6 flips or 3 to 6 flips where they're making $30,000 to $60,000 a piece. That's where we're talking a high possibility of it being reconstrued or assigned to UBIT.
Got it. Okay.
And that's where I would really say we want to jump into that. But most of my clients, once we have that conversation, they decide, you know what? I think I'm going to be better off being a lender on these deals.
Sure.
And avoiding the whole situation.
Yeah, right. Save them probably some heartache too, or at least some day-to-day stress.
Understatement completely. That said, the power of these accounts is huge. If you are just acting as a lender, and I have clients who are lenders and they might earn, they're often lending a higher LTV than normal, which is a little riskier. So a riskier loan means a more lucrative return. Would you agree?
Of course. Yeah, that's the idea. Yep.
Exactly. So we will often structure those deals for a slightly higher interest rate or potentially a small variable interest rate depending on the deal. But you still have to be careful with that and how it's exactly structured. Most of those have a baseline interest.
Because if the variable portion of the rate depends on essentially the underlying business, then that portion could be considered UBIT, right? Or UBTI, excuse me.
Yes.
My acronym.
You're good. That's exactly the problem. It's exactly the problem. Any questions for me on fix and flips?
No, that's really good feedback. That's always a hot topic. Let's Airbnb. Okay,
I love Airbnb, and I'm gonna start off on a
Do you think they're gonna come back? There's a lot of talk that they're done, but it seems like they are coming back. People want to
come back.
People have cabin fever.
I agree. I already have a ton of clients that are already getting a ton of bookings back again. So I'm not too concerned about Airbnbs. I don't think it's going to hit the amount of leverage that it was before. I think it kind of had to hit that bubble. Towards the end there, you couldn't have gotten me to invest in one because they were popping up everywhere. And that's when we run into problems with everything.
Sure.
Now, Airbnb is a fun topic. Your average Airbnb is really just a vacation rental. I buy a property on the Gulf Coast. It's a great beach house, and it'll rent out for $3,000 a week or more. And I think that one would just be a prime lovely example. So I keep my average tenancy under 7 nights so it remains non-passive. I would be doing that if I own it personally, because then I have no limitation for loss. That basis is in IRC 469, which I know nobody's going to go and read that, but for any of the really savvy people who are wondering about it, that's the place to go look it up.
We have a lot of engineers that watch and listen.
I know. That's exactly who that was for, was the engineers.
We love you, engineers. We love you, engineers.
I do love engineers. They do their research and they ask great questions.
Well, you're talking about if you had your money in your savings account.
That's correct. Inside of a retirement account, I don't run into the issue of whether or not I can deduct it or not. If I pay cash for the property, it's just rental income, especially if I have somebody else managing it, which I want to have somebody else manage it when it's in a retirement account. But that Airbnb in reality is probably not going to be subject to UBIT, simply because it's rental income. and it hasn't hit the level of a trade or business based on the definition of rental income being passive or non-passive. Now, that said, I start buying 15 Airbnbs and we set up a management company for all of them. Well, that might start to turn into kind of an actual business there. So you really want to kind of watch that line, especially the person who might be looking to do a little bit of arbitrage. So I'm not sure if you're familiar with that, but that's where someone will rent a property under a master lease.
Yep.
And they will rent it out via Airbnb. These costs.
Oh yeah. Yeah. Yep. I know a lot of folks that do that. Yep.
They cause me a ton of stress. I get the strategy, and if you have a great property that somebody doesn't want to sell, or you might have, an agreement to purchase it in a couple of years, it might be a great situation. I don't think it's a good idea for your retirement account. I think it's just very dangerous. I think that very easily could be construed as a business, and here's why. I buy a property, I buy real property. That real property is an investment. I'm hoping that it's going to appreciate, and I'm hoping that it's going to cash flow. If I'm renting a property and then renting out that property, well, I'm just kind of trading. That's a little more active in there. Where's my investment intent?
I hear you.
It looks like it's more a short-term transaction, or a year-long transaction in that case. And it's just going to continue to run like that. It looks like a business. And that's where my concern is.
Especially if that maybe a factor is how long the lease is too, right?
That is quite possible. And I'll be honest with you, the shorter the term of the lease, the less likely I'm going to like it.
No, I'm talking about the master lease.
That's
like if you have
the shorter term of that lease, the less I'm going to like it. That longer term lease shows that, it's just going to kind of sit there for a while, and you just wanted to kind of set it and forget it a little bit. But that shorter term means you have to renew it. It means you have to jump in and be more involved. The general test that we would consider is, what's the difference between you doing this investment versus researching and purchasing a stock and maintaining it?
Okay.
That's how they're primarily going to kind of outside looking in. Because remember, if it's under audit, it's not going to be the attorney that's looking at it. It's going to be Joe lowly IRS agent who knows the baseline, and they're going to assess their opinion. Meanwhile, you're paying fees to your attorney, your CPA, or your enrolled agent for representation. And by the way, when it comes to that retirement account, it's going to have to come out of the retirement account to pay for it.
Right.
So we really want to make sure that we keep things very clear and concise, because I have to go through either an office or a field audit first. Then I have to go into a manager's conference. Then I have to go and file an appeal, a local appeal. Then maybe I file a tax court petition, which gets kicked back to another level of appeal. And at that point in time, you might have just cost yourself as much money as it was worth. And by the way, if you use the wrong retirement account to do this, guess what you just cost yourself?
Your retirement.
Your whole retirement account, potentially.
Right. I mean, your retirement. So it's maybe, even if you win, you might lose.
And that's exactly it. You have to factor in the hazards of litigation in there. But to jump right back there on that exact topic, there are procedures to remedy prohibited transactions in a 401k account. So if somebody accidentally uses personal funds, or somebody accidentally makes that kind of mistake with that 401k account, there's a procedure to fix it.
They have the fix it guide.
What was that?
They got the fix it guide.
Exactly.
Yeah.
If you do it with an IRA, guess what happens?
No fix it guide.
It's gone.
Yep.
It's gone. If you have $300,000 in that retirement account, it's considered distributed at the very beginning of that calendar year.
Yeah.
January 1, which means no 60-day rollover, no out there. That's where we have a big problem. So I'll pick a 401k time and time again.
Yep.
George, I know this one comes up all the time here. Buying stock on margin.
Yeah, more and more. We're seeing it more and more. Yeah.
What are some of the questions that you guys get?
Well, we get a lot more about just the mechanics. Like they're looking for a brokerage that's going to allow them to do it, right? So,
Okay.
and we, of course, you know, we educate them on the potential issues from, you know, UBIT, you're actually an Unrelated Debt-Financed Income Tax perspective. But I mean, that's really at a high level where it comes up from our perspective.
The joys and chaos here. Buying stock on margin, I would avoid it in my retirement account, to be honest with you.
Why is that?
The UBIT calculations are going to be a whole lot of fun, especially if somebody's doing it frequently. Like many people who are buying on margin are looking to do, it's going to be a problem. The other issue that you have is collateral. How much of your account is collateral?
Sure. That's the other piece, is that because these are retirement accounts, if they have to put more money into that account, they may not be able to do that.
That's
because
exactly
it would have to come from a rollover, or it'd have to come from a contribution. If they are not eligible to make a contribution, or they don't have any more money to roll over,
right.
They're between a rock and a hard place.
Oh, I see it all the time. With other situations, I see it all the time. I do a lot of damage control, to put it mildly.
So it's good to talk with you early.
It is, and all throughout it. Talk to me about what's going on. Check in, see. You know, sometimes you just want to bounce an idea. Hey, I'm thinking about doing this. You know, we can hold up the stop sign there and say, please don't do that, and here's why. Or
Sure.
Here's how we would structure that in an alternative fashion.
You've seen this movie before, and it doesn't end well.
It doesn't end well. It doesn't well.
Can you touch on, before we run out of time, can you touch on the syndicated? Because that does come up now and again as well. The syndicated real estate transactions, for example.
So syndications are great. And we talked a little bit about rentals in a retirement account and how we calculate UDFI. It's going to operate very similar. And almost exactly, because your average syndication is buying a long-term property and operating or holding it from there. So your average syndication, you're just going to be receiving a K1 from there. I'm going to get a little bit of additional information from the organization itself. But for the most part, it's going to operate just like our conversation back up there about rental real estate. So whatever your net profit is after all expenses, that amount is going to be subject to UBIT or UDFI. Or sorry, is going to be UDFI, which is subject to UBIT.
So let's say it's an apartment complex, 12-month leases. You would think that's rental income, but if it's inside of an IRA, and of course the syndicator is going to leverage the investment money.
Yep.
Then you're just going to get your share of that income, and whatever your share of that income is, you know, based on the debt ratio.
Correct.
Does the investment provider provide that?
They will provide a strong majority of the information. Occasionally, I have to ask them for some average balances, etc. But for the most part, it'll be a fairly straightforward transaction. And there's a common misconception that if it's a loss, I don't have to report it. That's not true. That's not true. You want to file it, and here's why. There is a 10-year time frame that loss will carry forward as a passive activity loss. If that property is sold in, say, year 6, and it's been showing a $4,000 loss every year, well, 4 times 6, 24.
24, yeah.
If you have a gain at that point, well, I want to be able to use some of those losses to offset that brand new UBIT on that sale of the property that was debt financed.
Right, yeah.
So if I don't file those returns and I don't report it, I'm not going to be able to carry that loss.
Okay.
That's especially
Excellent.
important if they cost segregate the property.
Okay, so I get that. That's helpful. The only other thing left on our list is investing in a business. So
Yep.
let's say you want to invest in a restaurant. It's a food truck.
I hope it's set up as a C Corp.
Exactly. Yep.
Do you mind if I touch on ROBS a little bit here?
Sure.
Okay. ROBS, it's ROBS. It's called a rollover as business startup.
Oh yeah, we do them all day long.
They're called ROBS for a reason because most people don't know how to operate them. If you have a good business background, I think they're great. I know a lot of people that have been very, very successful with them. But make sure you capitalize. Make sure that you keep funds separate. We don't want to run into a situation where a distribution that should have gone out to the retirement account goes out to you personally. There's a ton of chaos that can happen. So if you engage in a ROBS, you need to have your advisors work along with you. It's going to be of the utmost importance. But you can make a ton of money by doing so.
Great. That's consistent with the message we always give. There's a proven path. It's recognized, but there's important requirements that need to be followed at the beginning and throughout.
I always say when clients come to me and they talk about wanting to open up their own business, there are people that are great at what they do. And I mean, amazing employees. They're great at running this business or doing that as an employee. But some of them are horrible business owners.
Sure.
We spend a lot of time as advisors teaching them how to be business owners, coaching them along through it. So it's not just tax returns. It's not just bookkeeping. It's advising. We take on that CFO role so we can guide you through that entire process from start to finish. If you don't ask us, we can't help. And I preach it all the time. If you don't ask us, we can't help. The worst mistake you can do is making a huge move without getting investment advice.
Good, great message to end it with, Stephen. So thank you so much for your time. Let's put up a screen so people can see how they could contact you. And then
I have a digital calendar on my website, so you can always throw a time right on our calendar for a consultation. Emails are always great. We're in the office all year long. We work with our clients constantly.
Excellent. So, well, great. So, and right now you must be in Chicago?
Yep. I'm
okay.
At the moment.
Summertime in Chicago. So, all right. I guess, and I think they're bringing back the baseball season. So,
I haven't heard that yet.
I think I saw something on my phone. I got an alert that I think the baseball season's coming back. So
I'm still pulling for football season.
Yes. Yeah.
The Chicago Bears are supposed to play the Buccaneers this season.
Oh, okay.
My wife, being from Tampa, is a Buccaneers fan.
I see.
And she's way too happy about having Brady on her team.
Oh, yeah, that's right. Yeah. Wow. I guess I'm going to have to, I'm a Michigan man, so I guess I got a new pro team to cheer for. With Brady going to Michigan, but you must be a Bears fan.
I'm a Bears fan through and through. But
Yeah.
George, any questions that you guys might have, or if your clients have any questions, never hesitate to give me a call, or if we need to hop on a conference call, I'm always more than happy to.
Thanks a million, Stephen. Thank you so much.
No problem.
Take care.
If other topics pop up, let me know. We can cover those.
Okay, will do. Take care.
Take care, George.
Bye-bye.